Welcome options traders. Hello everyone. And I wanted to post this video here because I had a feeling this was going to be a good example for it. And I'm talking, of course, about the earnings on Amazon that were released on Friday morning. And usually whenever there's a big anticipated earnings, all the big FANG stocks, any big tech stocks, I often get flooded with emails from traders saying, should I place a straddle right before the earnings are released? And the reasoning is fairly simple. It's a mistake that a lot of people fall into, but the straddle will make money whether the stock price rises or falls. At least that's the way it's often sold. But you're going to find out it's not quite that easy. So traders often think if I buy the straddle, no matter what happens to the stock's price, I'm going to make money. So let's find out the dangers of using straddles for earnings. First of all, what is a straddle? Well, it's one of many option strategies. It's actually quite simple to construct. What you're going to do is to buy a call and a put. And they're going to have the same strike. And they're going to have the same expiration. So, for example, you might buy the June 100 call and buy the June 100 put. And if you do, we would call that the June 100 straddle. If you bought 10 of them, you would have 10 straddles. So like any strategy, you can always scale it out. And the idea here is fairly simple. By buying the call and the put, you are, in a sense, straddling that fence there. You're playing both sides. And that's why it's called a straddle. You're going to make money if the stock price rises because you own the call. And you're going to make money if the stock price falls because you own the put. What could be better? Looks like you can't lose. Well, we're going to find out that's not true. But first of all, understand that when we construct a straddle, we usually build it as a delta neutral position. And that's just a fancy way in options trading terms to say we don't really want it to have a bias to the upside or the downside. In other words, we want the strike prices of the calls and the puts that we're using to be equal to the current stock's price. Now, in the real world of trading, it's going to be difficult to find a straddle that is trading for exactly the current stock's price. And even if you do find it, a couple seconds later, it's probably not going to match. So we try to get something close. And in doing so, we're saying I don't really have a bias or an opinion as to whether it's going up or down. So I want the stock price to start right here at the strike. And if it goes up, the calls make money. And if it goes down, the puts will make money. Let's take a closer look at the straddle and find out why that's probably not going to happen. The profit and loss diagram tells a lot about the straddle, and for those of you who don't understand profit and loss diagrams, there is a video in this forum right here that talks about profit and loss diagrams. But the profit and loss diagram for a straddle looks like this V-shaped figure right here. And the reason for it is fairly simple. If the stock price rises, you're going to end up making money from the long call. That's where these deltas are coming from, or this angled portion of this profit and loss diagram. It's going to behave like long shares of stock. And on the other hand, if the stock price falls, you've got negative deltas, or it's behaving like short shares of stock here to the downside. So once again, you're straddling that $100 price. No matter how high that stock price may rise, you can make money in an unlimited fashion. As high as the stock price goes, you're going to keep earning money. Why? Because you own a call. But even better than that, no matter how far the stock price falls, you're also going to earn, at least down to a stock price of 0. But the point is that you are in the green. You're in profit territory if the stock price rises or falls. Now again, that's usually how it's sold, especially by a lot of websites and trading services that say, hey, here's a strategy that makes money whether the stock goes up or down. It's not entirely true. The better way to word that is that it makes money if the stock price rises or falls sufficiently far. We need the stock price to make a gigantic move to the upside, not just up, but a gigantic move to the upside, or a gigantic move to the downside before it's going to start earning money. So the good news is that you can make an unlimited amount of money if the stock price rises or falls in an aggressive manner. But if it sits still in this area here, you are faced with losses. And that's a general principle of option strategies. If you need the stock to make an aggressive move, you're going to lose money if it ends up sitting still. And conversely, if the strategy needs the stock price to sit still, you're going to lose if it makes a big move. You can't have both. And that's what we're seeing here in the straddle. Yes, you can make money if you get large aggressive moves, but if it stays in the center region here, you're going to lose. Now the problem is that the center region is quite wide. Let's say that we paid $10 in total for the call and put. In other words, we paid $10 for the straddle. What that means is that our break-even points right here where this yellow profit and loss curve crosses this zero horizontal line right here, your break-even points are going to be 90 on the downside and 110 on the upside. In other words, we need the stock price to rise 10 points above that $100 strike, in other words, to a price of 110, before we're going to start earning money. Or we need the stock price to fall 10 points below that 100 strike, below 90, before that put starts earning money. And if it sits here right at 100 at expiration, we will lose the full 10. One of the good things about straddles is that it's almost impossible to lose the entire amount, because that means the stock would have to close at exactly 100.00. Probably not going to happen. So the probability of losing everything on a straddle is quite slim, but you could still be faced with very heavy losses. So what's the real danger of the straddle? Well, the reason that you have these very large break-even points is that you're not just buying a call and you're not just buying a put. Only the call can make money at expiration, or only the put. They both can't make money. So when you get to expiration, or the next trading day, or whatever your outlook is, you are buying a call for the price of the call plus the put. And if you're looking at that put's price, you're not just buying the put. You're buying the put for the price of the put plus the call. Again, why? Because they both can't be in the money. One or the other will win if they win at all, which means the other must lose. So if you think back to it with a basic call option strategy, you need the stock price to move a certain amount before the call makes money. If you have a put option, you need the stock price to fall a certain amount before it makes money. Well, now you need it to move by a certain amount before you can cover the cost of both of these. So essentially what you're doing is doubling the price of each option. If you think trading, let's say, out of the money calls or out of the money puts is difficult, try doubling those prices and see what happens. Okay, so again, the reason for this is that only one of these options can expire in the money. And so if the straddle is going to make money, you need the call to make up the price of the call and the put, or you need the put to make up the price of the put and the call. So let's go back to Amazon here. This was on July 26th, the day before earnings. So take a look here. The stock closed at 1808, and I've got the platform set to straddles. So what that means is that each of these strikes is really showing us the price of the straddle. It's showing us the combination of the call and the put at these various strikes. So with the stock at 1808, which strike is closest? Well, it's going to be right down here, the 1807.5. And look over here, the mark, the midpoint between the bid and the ask, 101.90, almost 102. That's $10,200 you're shelling out for one straddle. So yes, those options are very, very expensive. Now again, the mistake that new traders make is they say, well, if I buy this at 102, can't lose much money between today and tomorrow, and then I'm also going to get this big explosive move, whether it's up or down. So I got to make money. Well, take a look over here. What is your theta? Remember, theta shows you the rate of decay for 1 day's passage of time. Look at that, 101.40. In other words, this straddle, assuming all else stays the same, stock stays at 1808, this straddle is going to lose $101.40 on tomorrow's opening bell. It's currently trading for 101.90. It's only going to be worth 50 cents. Why is it even worth 50 cents? Well, look where the stock is. If it's at 1808 and you have the 1807.5, so those would be 50 cents in the money. So what it's telling you is that you are going to lose 100% of your extrinsic value on the opening bell. Therefore, the only reason the straddle is going to make money is from intrinsic value. So another way to look at this is that you need the stock to move roughly 102 points up or 102 points down before you're going to start making money. Any prices in between there means you're faced with losses. So here we are. This was shot literally at like 9:31, right after the market opened on July 27th. This was the first trading day after the earnings were announced. Stock traded at 1871, almost 1872, up $64. So how did you do on your 1807.50s? 65.5. How is that possible? How could you get a move of almost $64 but lose almost half of the value of the straddle? Well, again, there's no extrinsic value. This is pure intrinsic value. How much intrinsic value is there? Well, what's the difference between 1807.50 and 1871.97? Well, it's going to be about, what, 64.50, let's call it? So they were trading for 65.78. So if we subtract off 64.50, yeah, it means that that put was probably trading for about $1.30. So you've got a little bit of extrinsic value there on the put, but not much, not anywhere near the 50-some points you had yesterday. And so this is why you have to be so careful when you're trading straddles going into earnings. Now, there are ways that professional traders can capitalize on earnings in a much safer fashion. And usually what we'll do is we will buy the straddles or the strangles, a similar strategy, prior to the earnings, maybe 4 to 6 weeks out. And as that implied volatility rises, the value of the straddle or strangle will rise, and then we will sell it prior to earnings. But we'll have to save that for a future video. If you'd like to know more about the art and science of options trading, please check out the Alpha Trader course or Strategy Lab at optionsa2z.com. You're also invited to join us on the Facebook trading group Options A to Z.